guys? Welcome to a special edition of So Happy It's Thursday. Always, I am an educator, not a content creator. We keep it cheesy, but we keep it relevant. One of the things I want to talk about is high consumer debt. We have been mentioning about the HELOCs, second mortgages, standalone mortgages, about not touching your existing mortgage if you have a 30-year fix and a rate lower than today's standard rate. There are options out there that allows you to tap into that home's equity, whether it's through a home equity line of credit, whether it's a standalone second mortgage. There are ways that you can tap into the equity, get that money, so that you can use to either a consolidate some of your debt, put some cushion aside. Consumer confidence is depleted. What does that mean? The government, the banking system, money does not trust you. At this point, there is a high risk because we are already starting to see defaults. We're already expecting to fall into a repossession season for car loans. That is because we were not only overselling these cars where they were being financed for a lot more value than the vehicle's worth because of the supply chain, the chip shortage, et cetera, et cetera. Nevertheless, cars were being sold and financed for a lot more than their true value, knowing that they depreciate. We're having expenses associated with our everyday life. Inflation has caused the cost of goods to go up. We had the gas situation, but we also have the cost of financing, right? So now we're looking at defaults on credit, repos. We're having a lot of attorneys come back into the market offering their bankruptcy services. You can't get away from any radio station where you're seeing a lot of ads paid by credit counseling slash debt settlement. There's a lot of junk mail that's now arriving to people's homes where they're letting you know that, hey, guess what? You don't have to pay your bill. All you have to do is call us. We'll settle it, reduce your payment at the risk of crashing your credit, removing you from borrowing money entirely for about another 2, 3 years. And it's not even a guaranteed process. What they do is not pay the creditor until they force them to want to take something over nothing. And then essentially you get hit across the board on all of those straight lines and your credit is gone. Credit crunch. And if you've heard the term, what this means is that lenders are no longer either liquid or financially able to lend. Plus, with consumer confidence removed, they now want to limit who they even lend to. Ally got themselves out of the car lending game, Capital One. So there's a lot of the typical lenders outside of your BMW and Ford and GM. A lot of these other banks that were helping the subprime or not your top tier clients are removing themselves from providing finances to buy these vehicles, which is going to hurt. But again, the credit crunch, look, I've been doing this since back in 2005. So I was here for the crash. And we noticed that one of the first things that happened was credit tighten. Once credit tightened, we started seeing credit card companies start cutting your limit almost down to your balance. But then because your limit was close to your balance, now you were perceived as being maxed out on your credit. And then FICO comes in and takes care of the rest, which is now cutting your FICO scores because you're being maxed out. Some people are actually living paycheck to paycheck or borrowing from Peter to pay Paul, which means the credit cards are a facilitator. It's their own AMSCOT, if you will. It's their own pay advance. They use the credit cards to pay these things so they get paid to make the payment. If that credit card limit is removed from you, then you're going to find yourself where now you don't have Peter to even pay Paul. So now Paul just doesn't get paid. Once Paul doesn't get paid and you take that hit on your credit, now your credit is going to go into a free fall because once that late payment hits, now all of a sudden everybody else starts cutting their limit away from you, making you then being maxed out, which now that you're maxed out, there's another reason for FICO to penalize you on your credit. And next thing you know, you can't even borrow from Jacob to pay Paul. And there goes your only option now is either payment settlement, debt settlement, or bankruptcy. But once that happens at a grander scale, with consumer confidence already being so low, and the credit crunch situation happens, the banks then just close down all doors. Once all doors are closed, then at this point we have a bigger problem. That's why I have been suggesting, while home prices are where they are and homes have the equities that they have, I've been pushing to take advantage of that equity in your home, use that money and save your credit, save your financial situation by debt consolidation, paying off some debt, reducing your monthly exposure, because mortgage is on a longer term and it's on a lower rate. It's going to have a lower payment than what you're typically paying in all the minimum payments combined, which will give you some freedom as far as alleviating some of your financial monthly burden. And you could even put some cushion funds for a rainy day. At any point, avoid at this time any adjustable rate mortgages or adjustable rate loans, because we are now in a predicament where from now to 2025 there is going to be certain hikes. I've noticed a lot of people with the SBA loans, when the SBA loans were out there helping right after the PPP and the ERC, those loans were adjustable, and a lot of those payments are now going up and up and up with the rate adjustments, and eventually it's going to put people in a financial crunch. Other thing I want to talk about is the DSCR loans, which is the debt service coverage ratio. It was a popular loan that we're doing to help investors acquire properties with the sole purpose and intention of renting them, building portfolios. It's an amazing loan program because there's no income verification. You just got to have the credit score, have the down payment, and the rent of that property should suffice enough to cover the mortgage payment. That gives the 1-to-1 ratio, and that's what qualifies you. Now, because the combination of higher home prices and higher rates, it's kind of tightened that a little bit, because one of the things is we're starting to see declining markets, right? We're starting to see some corrections. Some areas are deemed by the appraiser. On their appraisal, they'll list this is in a declining market. Right now, investing those this type of loans for investors, if the appraisal shows that it's in a declining market, there is an automatic 5% reduction on the loan to value, which means your down payment now has to go up by 5% if it reports as a declining market on the appraisal. Also, we went ahead and priced a scenario to give you an idea how that is, how the market is kind of forcing some editing of this program. We did a scenario of a purchase price of $300,000, 700 FICO client, 20% down. We're looking at a payment between the mortgage, taxes, insurance, about $2,145.54. You would have to essentially be able to rent that property for $2,400 monthly rent to put you at a 1.11 ratio of the rent to the payment. That would qualify. Some lenders allow under 1-to-1 ratio with a higher down payment and higher rate. Some will require you to meet at least 1.2 ratio on that debt service. So what you do is just take the 2,400 rent divided by the mortgage payment, and that gives you that ratio. You want to make sure you're over one at least in order to get the better product offering. But as you can see, you're now looking at having to rent at minimum of 2,400 to be able to compensate the rent to the mortgage payment, and that's what's making it difficult for a lot of these individuals, because they're seeing a great opportunity as far as investing opportunity. The problem is that because the rent market area, the payment is neck and neck, or they could not even rent it enough for that. Now, duplex, triplex, and quadplex are still a big bang for your buck, because you obviously get rental per unit, and at that the rental income compared to the mortgage payment clears almost 9 out of 10. But keep an eye out when you're looking into those loan programs. For bridge loans and fix and flips, we're noticing an average trend of about 12% interest, interest only, 12-month terms. This is the loan that basically facilitates you to acquire and either rehab or to stabilize certain things so that you can refinance into a more traditional conforming loan, or so that you can do what you got to do and sell the property for profit. That will be what flippers do. So we're noticing that usually 20-25% down, 12% interest rate, interest only, 12-month term seems to be an average on that. Commercial loans, this is the big one, because we got into the commercial loan market. Do not take an adjustable rate right now. There is a lot of banks that are offering not even a 30-year loan. They're doing either 5 to 10 and then adjustable. Right now, we're noticing that from now to 2025, there's going to be approximately 4 to 5% interest rate increases. If you take any of these loans, you are putting yourself in a position and situation where the rates can go up on you. And now you may find yourself, if you're not in the market with that commercial loan where you can increase the rent, or like renting, or even if it's commercial, keep in mind that the workforce is leaving the office space. It's not easy to justify raising rent when there are a lot of people are actually not finding the value in paying office space rent. There's a lot of loans coming due. The banks are hurting. Obviously, as you saw with the SVB, that just was the first domino in the chain reaction. So, with the banks hurting the way they are right now, and with the loans coming due and for default, what's going to happen is this: the rate's going to come up. When the rate goes up, so will the payment. If that business is not generating enough to justify that payment, they may want to take the hit initially. But what's going to happen is, how long before you're actually coming out of pocket or taking a loss because you're not generating enough to cover the rent? So this is going to be, I think, the real estate bubble that is going to be the next threat. It's not going to be the residential real estate market. It's going to be the commercial real estate market, because all the little banks that were almost taking 80% of the weight on this type of loans are now crashing or are removing themselves because the lack of protection with the FDIC and everything that happened, right? So what's going to happen is that the big banks are wanting minimal exposure. You Chase, your Bank of America, very minimal exposure. Now, if you're looking into getting this type of commercial loans, don't look into the big banks. We have sources. For instance, we have crowdfunding, hedge fund guys. We got private money that can still give a 30-year fix. I will take a 30-year fix at whatever rate they have today, which is normally about 2 points over government or what you will get at SBA. But you don't have to worry. You got your 30 years and fix, and not a 5 years and then variable, because at the 5 year mark, if there's no bank wanting to touch it to refinance you and your rate keeps going up, it could price you outside of the market. So those are the things I wanted to touch in today's video. I hope they were useful. If you have any questions or comments, like always, leave a message, hit me on Messenger, send me an email. We're here to help. And this has been So Happy It's Thursday. Thanks.